The concept of tax brackets is simple, but misunderstanding it can cause you to make mistakes that could cost you thousands of dollars. Hello and welcome to Practical Personal Finance. My name is Andrew Shear, and this is where I give you the information you need to understand and succeed with money. Today I'm covering the topic of tax brackets. I'm going to discuss why it's important to understand tax brackets, how to calculate the total tax you owe, and once you know that, how to calculate your effective tax rate. Remember to give this video a thumbs up, and if you're new around here, hit that subscribe button. You're about to learn something new about money. A few years ago, I heard a story about someone who had refused a promotion at their job because it would land them in a higher tax bracket. This person believed that with a raise, their take-home pay would end up being less because they would owe substantially more in taxes. This is part of a common misconception with how tax brackets work. And because this person didn't understand the concept, they sacrificed a promotion and potentially tens of thousands of dollars in income. In the United States, at the federal level, there are 7 different tax brackets that correspond with how much money you earn. And they can change based on whether you're single or married. So for the sake of simplicity, let's pretend that there are just 3 different tax brackets that apply to everyone. Bracket number 1 is for $1 to $50,000 of annual income. This bracket is taxed at 10%. Bracket number 2 is for $50,001 to $100,000. This bracket is taxed at 20%. And bracket number 3 is everything above $100,001. This bracket is taxed at 30%. Let's say you make $40,000 per year at your job. Your income level puts you in bracket number 1, so your earnings get taxed at 10%. 10% of $40,000 is $4,000. So every year, you'll end up paying $4,000 to the federal government to cover your tax bill. This is pretty simple, and it's the easiest part to make sense of. Now, what if your income was a little higher, say $70,000 per year? Now you're in bracket number 2. You might assume that the calculation is similar to the previous example. Just take 20% of $70,000 for a total tax bill of $14,000. But this is incorrect, and it's where a lot of people get tripped up. Calculating tax in this scenario is a 3-step process. First, you need to divide your income into the different tax brackets. Second, you need to calculate the tax owed in each bracket. And third, you need to add the taxes from each bracket together to get the total. In this scenario, the first $50,000 of your $70,000 income falls into bracket number 1, and it gets taxed at 10%. The remaining $20,000 falls into bracket number 2, and it gets taxed at 20%. Your total tax bill would be $5,000 plus $4,000 for a total of $9,000. Let's take a look at one more example. Say you made $180,000 per year. Congratulations, you're in the highest tax bracket. The same 3-step process we just used applies for calculating your tax bill. First, we divide your income into the different brackets. The first $50,000 fills up bracket number 1. The next $50,000 fills up bracket number 2, and the remaining $80,000 goes into bracket number 3. Now that the income is separated, we'll calculate the tax owed in each bracket. For bracket number 1, 10% of $50,000 is $5,000. For bracket number 2, 20% of $50,000 is $10,000. And for bracket number 3, 30% of $80,000 is $24,000. Finally, it's time to add everything up to get your total tax bill. So we'll take $5,000 plus $10,000 plus $24,000, and your grand total is $39,000. Once you've calculated your total tax owed, you can calculate something else called your effective tax rate. Your effective tax rate is the percentage of your total income that you need to pay in taxes. As your income increases, so does your effective tax rate. The formula for calculating your effective tax rate is simple. You take your total tax owed and divide it by your total income. Let's go back to the previous examples to see how your effective tax rate will increase as your income goes up. In the first example, your tax bill was $4,000 and your income was $40,000. Therefore, your effective tax rate was 10%. If you're in the lowest tax bracket, your effective tax rate will always be the same as the tax rate for that bracket. In the second example, your tax bill was $9,000 and your income was $70,000. Divide 9,000 by 70,000 and you get 12.86% for your effective tax rate. So even though you're in the second tax bracket, your average tax in this scenario is just 12.86%. In the final example, your tax bill was $39,000 and your income was $180,000. Your effective tax rate in this example would be 21.67%. So even though you had a total of $80,000 getting taxed at 30%, your average overall tax rate was still just a hair over 20%. It's only when your income becomes extraordinarily large that your effective tax rate will even begin to come close to the rate for the highest tax bracket. Do you have any other questions about tax brackets? Let me know in the comments. If you found this video useful, you'll probably enjoy this video about how to calculate interest on a loan, or maybe this one about how to calculate your net worth. Thanks for watching. I'm Andrew Scheer, and I'll see you next time.